Good morning, everyone. We're waiting just a couple of minutes here, give time for people to jump on with us. Hope everyone's doing well today. Okay, we're going to get going. Well, first of all, my name is Josh Stripmatter. I'd like to welcome you to Stripmatter Wealth Smart Money webinar series. Thank you for joining us. Our presentation today is titled Extended Care and Long-Term Planning, and will be presented by Susan Carlson at Crump Life Insurance Services. For those of you that don't know us, Stripmatter Wealth is a registered investment advisor located in sunny downtown Fort Worth, Texas. Our advisors are certified financial planners and fiduciaries specializing in retirement planning, investment management, estate planning, and real estate investing. Today's webinar is meant to be purely educational and not meant as tax or legal advice. So please talk to your licensed professionals before taking action on any of the information that's presented today. For more information, including key disclosures, please visit our website at stripmatterwealth.com. If you have questions or would like to schedule a complimentary consultation, please contact us at 817-210-3444 or email us at clientservice@stripmatterwealth.com. All right, a little bit of housekeeping before we get started. All of you have access to the chat feature, so if any of you have any questions, please don't hesitate to type those in, and we'll be happy to answer those for you today. Also, we'll be sending you out a replay of today's webinar via email. So if you missed something, don't panic. You'll have the ability to watch it again. It'll also be posted on our website at stripmatterwealth.com. So without further ado, let me introduce our speaker today. Her name is Susan Carlson, and she is with Crump Life Insurance Services. Susan educates insurance producers on the importance of long-term care planning and the various solutions available to address the needs of clients. Susan lives in Arizona with her daughter, Ava, and their many pets, and she is an avid animal lover. So without further ado, let me hand it off to Susan. Good morning, Susan.
Good morning, and thank you for having me. What I wanted to focus on today, and what Josh had mentioned, is this is really meant to be pure education. So we're going to talk about the different types of long-term care planning solutions that are in the marketplace today. We're not going to dive too deep into those, but we are going to spend some time, going through why planning is important and why it's something that you should have a conversation with your financial planner on. So this is probably one of my favorite quotes that says, there are many kinds of people in this world. There are those who have been caregivers, those who currently are caregivers, those who will be caregivers, and those who will need caregivers. So it's basically saying that every single one of us is going to be touched by an extended care event, whether it's ourselves or in fact with a loved one. Planning, when we're planning about planning for extended care, remember that we're not having a discussion on whether or not you're going to need care, but instead we're going to talk about setting a plan in place to help protect your family if or should you need care. And with the different types of solutions that are out there, there's a lot of different ways that we can put something in place where if you never need long-term care or have an extended care event, your family would receive all the money you put into this solution back upon your demise. So we're going to cover just real quickly the basics of long-term care, the types of care, who pays for this care, and what kind of solutions are out there in the marketplace today. So I always like to cover or just start with what is the definition of long-term care, because naturally what we automatically think of is an end-of-life event or a nursing home. And the bottom line is that really could not be further from the truth of what long-term care really is. Think of long-term care as just needing care for an extended period of time. It doesn't have to be something that we're going to be affected by for the rest of our lives. It could be because of a car accident. And how we define long-term care, it's measured in two ways. It's either physically based or cognitively impaired based. So with physically based, what we look at, or what part of the definition is the inability to perform 2 out of the 6 activities of daily living. So what those include is, just think of what we did this morning to get ready for our day. We all got in and out of bed, which is transferring. We were able to wait until the morning and able to use the restroom on our own. We were able to get a shower, get dressed, and have breakfast. Going back to that example, if I was in a car accident and I'm not able to get in and out of the shower or get dressed on my own, and the doctor said, Susan, it's going to take you at least 6 months to get back up on your feet, I need long-term care. So it doesn't necessarily have to be an end of life, an event, or again, something that's going to affect me forever. The definition is also long-term. So the need to have assistance has to be expected to last 90 days or longer. So let's say I had hip surgery, I go home, I need home health care aid there, but the doctor thinks I'll be back up and ready to go within 6 weeks. That would not qualify as a definition of long-term care. But let's say I get some type of infection, or I end up being disabled for 3 months or longer, that would be considered long-term care. The other way it's measured, and I think of this really as the catastrophic risk, is severe cognitive impairment. As we live longer, the dementia, the Alzheimer's is really on the rise. And with the cognitive impairment, that's actually how I came to do what I do. So my grandmother had Alzheimer's. She was diagnosed with Alzheimer's, and it ended up being like an 8-year care event. Now, my grandmother, my aunt and uncle, all my family lived back east. We lived here in Phoenix. So I didn't really get to see the effects of Alzheimer's on my grandmother. What I saw instead was how it affected the family dynamics. So my aunt and uncle, like usual, said, okay, well, we'll just take turns taking care of mom, which, that it went that way. And then as soon as my grandmother started leaving things on the stove, burning her food, that's when they knew that it was not safe for her to live on her own anymore. So my grandmother moved in with my aunt, stayed there for a few years until my aunt had to put her in a memory care facility where my grandmother passed away. So what happened with our family is the sharing of care did not necessarily happen, and it really fell more on my aunt's shoulders than it did my uncle. So this was well over 20 years ago that this happened, and to this day, my aunt and uncle still do not speak. So this event really just kind of ripped our family in half. And that's what I look at the planning. Granted, the money part is very important, but to me, the family dynamics, trying to ease that sibling tension, this can happen if we have a plan put in place for when we need care for an extended period of time. Also, with long-term care, most of our care is what we call custodial. It's not skilled, meaning I don't have to have an RN or a doctor come to my home. Instead, an aide would suffice. And Medicare and health insurance do not cover custodial care. They only cover what we consider to be skilled care. Most long-term care happens at home. And because it happens at home and it's provided by the family, it's really hard to measure and to get statistics. I mean, we love statistics. What is the average length of claim? How much is the cost? We really can't get our arms around that until the family finally hires the professionals to come in. So when you're reading statistics, remember that does not take into effect the 2 to 3 years the family struggled to take care of their loved one before they finally hired somebody. When I first started doing the long-term care insurance, there were only really two types of care. There was nursing home or home health care. Then assisted living popped up, where it was a nice medium in between the two, and the group homes. So a majority of all long-term care, well over half, happens at home. Nursing home is by far the most expensive, but also know it's the least utilized. And especially after the last year and a half, a facility really is the last place that we want to go. And by having a plan put in place, that could actually prevent you from having to go into a nursing home. So when you're setting up your plan, think of home health care, and then think of a group home or an assisted living facility, because again, that's really where the care is happening. Now, a lot of us will say, well, my family will take care of me. And I used to say that to my mom all the time. Mom, if you ever, are diagnosed with Alzheimer's, don't worry, I'll be there to take care of you. And it really was more of a love response because I didn't understand exactly what taking care of somebody is. Think of if I had to completely, or if your children completely had to stop their lives and then become a 24-hour caregiver, the amount of stress that that's going to add to them. The sibling tension, I can almost guarantee you that two of the children may never ever speak to each other again after an event like this. A lot of times my sister lives in Colorado. I'm here in Phoenix, so is my mom. So naturally, if something happens with my mom, it's going to be, really fall on my shoulders. And I know that I'm going to start to resent my sister who lives in Colorado, who isn't really affected. Her life isn't really affected by this because she lives at a state. The decline in well-being, it's a proven fact that those who provide the care, your well-being will decline faster than the person you're taking care of. And if you happen to be younger, the loss of income. What if your spouse had to quit their job in order to become a caregiver for another family member? There's a lot of articles, and I think this came from when we didn't have as many solutions out there to transfer the risk of if you're over a certain, if your estate's over a certain dollar amount, you can self-insure. Well, with the solutions that we're going to briefly talk about today, they're a win-win. So if you don't need long-term care, your family would get the money back that you put into this program. But if you did need long-term care, we have leveraged that dollar by 3 to 4 times and also provided tax-free benefits. So the question is why? Why would you ever want to take the chance of paying something dollar for dollar when you can transfer the risk? But a lot of times clients wait too long. We can't put together a plan that includes insurance when you need the care. It has to happen beforehand. But if you did wait too long or chose to pay out of pocket, of course, you have all the tax implications. If you start liquefying your portfolio, selling stocks, cashing in annuities, you're going to have the tax implications of that. What about the market timing? What if the market is down and we have to go in and start withdrawing $8,000 to $10,000 a month to help offset the cost of care? Liquidity, a lot of times our assets are in real estate. What would happen if I had to turn around and sell my home tomorrow in order to receive the funds for care? And then, of course, loss of future income. And this is where the spouse comes from. Remember, when you're putting together a plan, you're putting it together for your spouse and for your children. So if I'm having to use my retirement savings, a lot of that savings is put into assets that will provide an income. And if I'm eating those away, how is that going to affect my spouse's standard of living? So paying out of pocket, unfortunately, is what happens to a majority of us, simply because we never put together a plan. So thinking of who and what is important to you, this is what the plan is designed to protect. It's not saying you're going to need long-term care, but instead it's that safety net that if you did need care, this is what I want to protect. Now, a lot of us still believe that Medicare will cover the first 100 or so days in a nursing home, and I'm here to tell you that rarely happens. So in order for Medicare to cover anything of a nursing home expense, you must have spent 3 days prior, 3 entire days in the hospital. So someone like my grandmother who had Alzheimer's, she didn't spend a day in the hospital. But let's say that you do, and you are then moved to a Medicare approved nursing home. Medicare will cover the first 20 days, okay? And then after that, you have a copay. This goes up a couple of dollars every year, and then Medicare will pay the difference. But on the 100th day, it stops. So remember when I was talking about the definition of long-term care, how it has to be assumed or expected the care would last 90 days or longer? Because these policies pick up where our health insurance stops. So when I'm out training financial advisors, I always tell them, no, Medicare isn't going to cover long-term care expenses, and by no means are we going to plan on Medicare to cover anything. So if it does, it's a bonus, but we need to have a plan outside of Medicare. Now, Medicaid, and this is what happened with my grandmother, is what happens if you do need care and you run out of money. Well, that's when the state will come in and cover your bills. So with my grandma, of course, she ended up going through everything, that she had saved and ended up on the state program. In order to have Medicaid pay, though, you really have to be completely impoverished. So if you're married, all the retirement savings has to go. If you have a prenuptial agreement, that goes out the window. Everything has to be used for the care. Now, you can keep your home if you're married, and you can keep it's a little bit more, but it's around $100,000 in assets. So my question always goes back to, how is this going to affect your spouse? So there is a safety net or a government, program out there, but most states' Medicaid programs are in a lot of trouble because the majority of their funds are going to pay for long-term care expenses. Now, my dad was eligible for the VA benefits, but this can be, it's not as easy to receive benefits as one might think. In order to receive any benefits, they go by how severe your care is, or how severe your condition is, not how long you served in the military. And they don't necessarily cover the entire cost, and you have to use their facilities. So with my mom having Alzheimer's and her family history, I, as a daughter, bought, and I still pay for my parents' long-term care premium. So I bought them a standalone policy, and I didn't really buy it for them. I bought it for me because I know, being the oldest daughter living in state, if something happened, it would fall on my shoulders, and I'm just not set up to be a 24-hour caregiver, nor do I want to be. So my dad has since passed. He had a heart attack, so we never used any of the benefits on him, but I continue to pay my mother's premium, and will do so until she either needs care or until she passes as well. So again, a majority of us end up paying out of pocket because we either didn't have the information to set up a plan, or we simply waited too long. So when you're thinking of putting together a plan in place, now it doesn't have to include insurance. Just having a discussion, having a plan written out, because your family is going to be calling your financial advisor, and that advisor needs to know what your wishes are. But we look at the portfolio and say, okay, well, my husband and I have life insurance. We have some cash value in there. We could, use those funds. Or we happen to have a non-qualified annuity that we're using kind of as a just in case. So looking through what it is that you would use to pay for your care, and a lot of times we could take those monies, reallocate them, and provide more leverage than you would receive if you left them alone. So long-term care planning is kind of like the anti-nursing home. When you look at COVID, how COVID really affected the long-term care industry, and of course it's going to take years to fully see, but what it did is it really brought down the nursing home claims because families were going and they were pulling their loved ones out of these facilities and trying to provide the care themselves. So by having a plan, it really helps you decide where and whom is going to provide the care for you. Now, there's insurance policies out there in the marketplace. There is no one perfect solution. We are all different. And depending on our health, how we're going to pay for this, what our priorities are, help us decide what type of solution would fit you the best. And that's why it's really important that you speak with a financial advisor when trying to decide what is the best fit. So traditional long-term care, this is the purest form of coverage. It's health insurance, okay? But it's health insurance that's designed to cover a condition that will last 90 days or longer, okay? So because it's health insurance, it's a use it or lose it. So like with my dad, even though I paid the premium for, 15 years, when he died, I didn't get any kind of refund back. And also the premiums are not guaranteed. So the insurance company could increase and they have increased my mom's premium because the claims might not be as, expected, or they might have more claims. But because this is, let's call it a use it or lose it type of policy, the premiums are not guaranteed. This is the lowest premium out of the three solutions that are out there. And at the time, it's what I could afford. And so my mother has a very rich plan. There's all different ways that I can pay for this. So if you're a business owner, you can actually deduct some of the premium as a business expense. If you have an HSA, you can actually pull some money out of your HSA to help fund one of these policies. The next type of solution is becoming more and more popular because I like to call this as my guaranteed option, okay? So a lot of times we'll work with a couple, and the gentleman might sit back and say, I'm never going to need long-term care. This is a waste of money. What if we never use it? Well, they have and I'm going to call it a hybrid. It's like a combination product. So it's a traditional long-term care policy on a life insurance chassis. Now, the only reason for this scenario, there's life insurance, is it provides guarantees. So if I die and never need long-term care, whatever I paid into this policy, my family will get back as a death benefit. So if I paid $100,000, they'll get $100,000 back upon my death if I never needed care. The premiums are also guaranteed. They can't increase, and I can choose how long I want to pay the premium. With long-term care, because it's health insurance, I just pay the premium forever until I either, receive benefits or I pass away. With these policies, I could pay it in one lump sum. I could pay it over 10 years. I've got a lot more choices. Now, naturally, because this is guaranteed, the premiums are 2 to 3 times more than traditional long-term care, but you're also guaranteed to get that money back, whether it's in long-term care benefits or your family gets it back as a death benefit. So again, the death benefit really is more of a return of premium if you never need it. The last type of solution that are out there is life insurance with a rider. Now, how is that different from a hybrid? This is a death benefit focus. This is if the need for death benefit is primary and long-term care is secondary. Okay, so this, if I needed a policy and I bought it, it had a death benefit of $250,000. If I needed long-term care, that policy could pay out that death benefit monthly to cover my long-term care expenses. But long-term care, again, is secondary versus with this product, it's a primary focus. So a lot of times when I'm talking to advisors, I'll say, what is the client's primary focus? Is it long-term care? And if they say yes, then my question is, well, how do they want to pay for this solution? Are we moving assets around? Are we going to be paying it monthly or over a lifetime? And then lastly, and most importantly, how is their health? Again, you can't buy this once you need it. You have to buy it when you're healthy. So the policies all have components to them. And real quickly, we have how much will the policy reimburse you when you need care? How long will it reimburse you when you need care? And what type of deductible would you like? So with the traditional long-term care, it's very flexible in designing. With the hybrids and the life insurance, a lot of times we don't have a choice on, the benefit period. There's a couple of pieces that are locked in. But really you have the three components: how much, how long, and how soon. And depending how you design it, of course, affects the premium. So with traditional long-term care, just think of it, it's health insurance. It's the most flexible. It's the least out of pocket. But if you don't need it, you don't get anything back. And the premiums are not locked in. With the hybrid policies, this is our guaranteed long-term care policy, meaning it's guaranteed that if you never need long-term care, your family would get whatever you paid into the policy, usually nothing more, back in the form of a death benefit, and the premiums are locked in, but it's going to be 2 to 3 times the cost of traditional long-term care. And then life insurance with a rider fits very nicely if death benefit is your primary focus, that's what you have a need for, and long-term care is secondary. So there's a lot of different options out there now that can really fit for what it is that you personally need. And of course, the premiums vary on your age. The older we are, the higher the cost is. Gender. So women, out of every dollar in claims that are paid, 70 cents is for a woman. And that's simply because we live longer. The longer you live, the higher the probability is that you're going to need care at some point in your life. So due to utilization, because we use this policy, our premiums are 30 to 40% more than men, which goes to show you how important it is that we have some type of plan. Health. This is a real catcher because you tend not to think about this until something starts going maybe a little haywire, or maybe a diagnosis has been made of MS, Parkinson's. At that point, it's too late to be able to put some type of long-term care insurance program in place. You would have to look maybe at how you would invest your money differently. But health is extremely important, and one, I like my advisors, or I train them to get the health information up front. So that way I can go to market and see, okay, which insurance company would be the best fit. Then come back to the advisor and say, okay, your client has these options, and then they move forward with the meeting with their client. All different ways that we can pay for a solution. Again, we can reallocate some of your assets. If you have life insurance, it could be a point where the house is paid off, the kids are gone, I don't have a need for death benefit anymore. We could look at converting that possibly into a long-term care solution. Same thing with annuities. We can use some qualified money. You're still going to have to pay taxes on it, but there's ways that we can use qualified money, or just if you just want to use cash. So my goal today is to educate, to let you know there's not one type of solution out there, that there's quite a few different types of products, and depending on how you want to pay for this, and how is your health, what is it that you want personally, what are you comfortable with, your advisor can find that solution for you. So we touched very briefly on the types of policies. I would highly recommend reaching out to Josh's office and setting up some time to have a one-on-one, have a honest conversation, and let's see what type of solutions are available and whether or not they would fit for what you're looking for. So with that, Josh, I'm going to go ahead and pass it back to you.
Susan, thank you so much. That was very interesting, as always, and hopefully everyone learned quite a bit today. If you have any questions, I'm going to stick around a little bit after today's presentation, and you're welcome to just type those in. But you're also welcome to schedule a complimentary consultation, and you can see our phone number on the screen there, as well as the email address. Also, you may be interested in signing up for our weekly market update newsletters, e-newsletters, and you can go to stripmatterwealth.com, and there's a screen that pops up that you can sign up for our newsletters. Also, check us out on the radio. I'm on the radio every Saturday at 10 a.m. on 1190 a.m. on a show called Ask the Experts. So if you haven't tuned into that, please do. And we talk about topics like long-term care. So love to have you listen. Again, if any of you have any questions, type those in and we'll get those answered for you today. Otherwise, Susan, thank you so much for presenting today. Great job. Thank you so much.
All right. Well, have a great weekend.
You too.